Stifel Financial just delivered their Q2 2026 results, and they beat consensus across the board. Net revenue came in at a record $1.45 billion, edging out the $1.42 billion Wall Street estimate.
Yeah, and on the profitability side, non-GAAP earnings per share printed at $1.42. And the market obviously liked what it saw. The stock caught a really nice bid right after the report dropped.
Right, because it was a record second quarter for both net revenue and net income, basically capping off a record first half of the year for the firm.
Exactly. I mean, they are firing on all cylinders right now.
But for you listening, whether you're, managing your own portfolio or just tracking the financial sector, you really need to know what's driving those numbers. A headline revenue beat is great for a press release, but it doesn't actually tell you if the underlying business is healthy.
No, it definitely doesn't.
So today, we're doing a deep dive into Stifel's Q2 earnings, their management presentation, and some industry data to look under the hood. We're going to break down their segment performance, decode what management is saying about their strategy, and shine a light on some hidden risks buried in that balance sheet.
Yeah, and looking at the management deck, I mean, the overarching theme here is really just how a diversified financial firm generates cash in totally different macro environments. The actual mechanics are always buried like a few layers deeper than those headline numbers.
So let's dig into those layers, starting with what is clearly the bedrock of Stifel's business right now, which is global wealth management. Because revenue beats don't just happen by accident.
Right, you need a really stable foundation.
Yeah.
And global wealth management is absolutely that foundation for them. I mean, they reported record net revenues of $956.5 million just for this segment. That's a 13% year-over-year increase.
Wow. And the sheer volume of assets they're managing is staggering. Total client assets hit $580.1 billion.
Up 12%.
Up 12%, right. And fee-based assets specifically hit $239.8 billion. But I got to push back on this narrative just a little bit.
Okay, play it on me.
Whenever I see a wealth management division posting like 12 or 13% gains in assets and revenue, I immediately wonder if they're just catching a ride on a broader bull market.
Oh, you're asking if this is just beta.
Yes, exactly. And for anyone unfamiliar with the term, beta basically means riding the natural wave of the market. So if the S&P 500 goes up 10%, the value of the assets you manage naturally goes up 10%.
Right, and since your fees are a percentage of those assets, your revenue climbs without you lifting a finger.
Exactly. So I want to know if Stifel is actually generating alpha here. Like, are they creating their own weather through operational excellence, or are they just a passenger on this rising macroeconomic tide?
Well, to find that alpha, you really have to look past the raw volume of the assets and look at how Stifel is actually acquiring them.
Yeah.
Based on the earnings presentation, their primary moat isn't a proprietary trading algorithm or some exotic financial product. Right. Their moat is human capital. They are aggressively recruiting top-tier advisors away from their competitors.
Okay, let's explore the mechanics of that. Because high net worth clients don't usually just abandon their wealth manager unless there's a very compelling reason. So how is Stifel pulling that off?
It really comes down to culture and advisor support, which I know sounds like corporate HR speak until you actually look at the third-party validation.
Like the JD Power rankings.
Exactly. Stifel ranked #1 in employee advisor satisfaction for the 4th consecutive year. And they didn't just win the overall category, they swept the #1 spots for leadership and culture, operational support, and products and marketing.
I mean, earning that top spot 4 years in a row, that's a systemic advantage. That's not a fluke.
No, not at all. And when a firm builds a reputation for that level of support, it just becomes a magnet for talent at rival wirehouses. Look at the actual numbers they provided they recruited, trailing 12-month production totaling about $30 million over the last year.
Let's translate that phrase, trailing 12-month production, for our listeners, because it's industry jargon.
Sure.
Basically, if an advisor at a competing bank generates $1 million in annual fees for their firm, they have a $1 million production level. So Stifel recruiting $30 million in production means they are poaching the equivalent of 30 of those heavy hitters.
Right. And when those heavy hitters move across the street to Stifel, they bring their clients with them. In wealth management, high net worth clients are loyal to their specific advisor, not the logo on the building.
Yeah, that makes sense.
So that $30 million in recruited production, that represents tangible, hard-fought market share being taken directly from competitors.
Yeah.
It's not just passive market appreciation. They're actively expanding their slice of the pie.
And the way they're retaining those human advisors is where this gets truly fascinating to me. Digging into the management commentary, they have this very deliberate focus on artificial
Oh,
intelligence.
absolutely.
But what caught my eye is what they're actively avoiding. Because we hear so much about robo-advisors, right? Algorithms designed to just completely replace human brokers to save on salary costs. But Stifel is doing the exact opposite.
Yeah, they're deploying AI strictly as an efficiency multiplier for their human workforce. The goal they stated in their deck is literally keeping employees at the center of the client relationship.
Right.
So they're using AI to drastically reduce the time it takes to, conduct portfolio analysis or generate presentation decks or manage all that back office compliance logging.
I kind of look at it like they're giving their wealth managers Iron Man suits.
Oh, that's a great way to put it.
Right, like the human is still completely in control, flying the suit, making all the judgment calls, but the technology is doing all the heavy lifting.
The Iron Man analogy fits perfectly. I mean, think about the daily life of a wealth manager. You're gathering historical data, comparing mutual fund performance, formatting a 50-page slide deck for a quarterly client review.
Just massive amounts of grunt work.
Exactly. It's necessary, but it doesn't generate new revenue. High net worth individuals pay premium fees because they want a human being to call when the markets get volatile. They do not want to talk to a chatbot.
No, they definitely don't.
So by automating the grunt work, Stifel frees up the advisor to focus exclusively on relationship building, client psychology, and prospecting for new business.
Which feeds right back into that #1 JD Power ranking. I mean, if your current firm forces you to spend 20 hours a week manually building spreadsheets, and Stifel offers you an AI tool suite that does it in 20 minutes.
A no-brainer.
Yeah, the
Right.
choice to jump ship becomes obvious. The technology basically acts as a massive retention and recruitment tool.
It creates this self-reinforcing flywheel. Better tech leads to happier advisors, which leads to better client retention and easier recruitment, which ultimately drives that $956 million revenue figure we were talking about earlier.
Okay, so we've established wealth management as the stable base. It's recurring revenue, sticky assets, highly predictable. But we really need to pivot to the other side of the house. Because the explosive, high-octane growth this quarter, that didn't come from wealth management.
No, it did not.
It came from the institutional group.
The institutional group is definitely where we saw the fireworks.
Mm-hmm.
I mean, institutional net revenues hit $480.7 million for the quarter. And the specific engine driving that beat was investment banking.
Right.
Those revenues just soared, up 42% year over year to $323.2 million.
A 42% jump in a single year. That requires a structural shift in the market. Let's break down the components of that investment banking surge. So advisory revenues, which covers things like mergers and acquisitions, up 24%.
Yep.
Fixed income capital raising was up 18%. But the metric that practically jumps off the page is equity capital raising. That skyrocketed by an incredible 121%.
Yeah, seeing equity underwriting jump 121% year over year, that tells a very specific macroeconomic story.
Mm-hmm.
Because for the last couple of years, the capital market's been completely frozen. We had rapidly rising interest rates, deep uncertainty about inflation.
I picture it like a massive traffic jam. Like you had all these companies desperate to go public or issue secondary stock offerings to raise cash, but the market conditions were just terrible. So they just sat idling on the on-ramp waiting for the congestion to clear.
That pent-up demand builds and builds. But eventually, companies can only delay raising capital for so long, right? They have to execute their growth plans or refinance their debt.
They need the cash.
Exactly. And in Q2, the environment finally stabilized enough for that traffic jam to clear. The window opened, and companies flooded the market. And firms like Stifel, who, maintained their advisory infrastructure during the lean times, they were perfectly positioned to capture that sudden rush of deal flow.
But hold on, we need to look at the trading side of the institutional group as well, because the investment bankers and the underwriters were clearly working overtime, but did the transactional side of the house actually match that momentum? Like, 121% jump in equity capital raising is phenomenal. How did the actual trading desks perform?
Well, they actually went in the opposite direction.
Really?
Yeah, and this highlights why you always have to read the fine print on these earnings reports.
Yeah.
Fixed income transactional revenues actually dropped 26% year over year.
Wait, a 26% drop? That sounds catastrophic on the surface. Why is fixed income trading collapsing while underwriting is exploding?
It looks alarming until you dig into the comparable data from the previous year. This is a classic accounting illusion. In Q2 of last year, Stifel recorded a roughly $30 million realized gain from their aircraft business.
Let's pause right there, because I imagine you listening are wondering why a financial services firm is operating an aircraft business in the first place.
It's a very fair question. So, many large financial institutions actually operate leasing divisions. They buy highly capital-intensive assets. We were talking commercial Boeing or Airbus jets, and they lease them back to the airlines for 10 or 20 years.
Oh, I see.
It operates almost like a fixed income bond, providing a really steady yield.
Yeah.
But it is totally non-core to a traditional investment bank. And Stifel realized a massive one-time gain by shedding some of those assets last year.
Okay, so they essentially sold off planes, booked a $30 million windfall, and that spiked last year's Q2 numbers artificially high.
Exactly.
So now, a year later, without that one-time windfall, the baseline fixed income business looks like it shrank by 26%, even though the core trading operations might be perfectly stable.
Precisely. It's what analysts call a tough comp. When you strip out that $30 million aircraft anomaly, the fixed income trading business was completely normalized.
That makes total sense. But what about equity trading? Did that suffer from a tough comp as well?
So equity transactional revenue was also down. It dipped about 4% year over year. But the context here reveals a very deliberate strategic move by management. That 4% decline is almost entirely attributable to a $9 million reduction tied to the restructuring of their European equities business.
Restructuring, which is usually just a polite corporate term for cutting unprofitable operations. Why target the European equities desk specifically?
Because it is a notoriously difficult environment to turn a profit in. Since the introduction of the MiFID II regulations in Europe a few years ago, investment banks were legally forced to unbundle the cost of their research from their trading execution fees.
Meaning they couldn't just bury the cost of their analysts' reports inside the massive trading commissions they were charging clients anymore.
Right.
So clients started paying only for the raw trading execution, which just drove margins to the absolute floor.
Exactly. It became this total race to the bottom for fees. By restructuring and shrinking their footprint in European equities, Stifel's management is showing extreme discipline. They're actively trimming the fat, they're walking away from low-margin, hyper-competitive businesses, and they're reallocating those resources to the high-margin advisory and underwriting segments where they clearly have the hot hand right now.
Which brings us to arguably the most critical part of this entire analysis. Top-line revenue growth, whether it's from wealth management or investment banking, is basically meaningless if the company burns through all the cash before it reaches the bottom line.
Oh, absolutely.
So let's talk about profitability, margins, and how Stifel is actually returning capital to the people holding the stock.
Well, management executed brilliantly on operating leverage this quarter. Let's just look at the non-GAAP compensation ratio. On Wall Street, human beings are your biggest expense. So the percentage of your revenue that goes strictly to paying your employees is your compensation ratio.
Right.
Stifel managed to drop theirs to 57.0%, which is down from 58.0% a year ago.
That's a full 100 basis point drop, meaning a full 1% reduction in their compensation ratio. And when you're dealing with $1.45 billion in quarterly revenue, freeing up a full percentage point drops an enormous amount of cash straight to the bottom line.
It's massive. And that discipline on compensation, when you pair it with the explosion in high-margin investment banking fees we just talked about, it pushed their non-GAAP pre-tax margin to a very healthy 21.7%.
Nice.
They are getting incredibly efficient at converting a dollar of revenue into actual profit.
And they aren't just hoarding that cash either. They're being very aggressive about returning it to shareholders. During the second quarter alone, Stifel repurchased 2.4 million of their own shares in the open market, spending $177 million to do it.
Yeah.
That averages out to an acquisition price of $73.20 a share.
Share buybacks are such a powerful signaling mechanism. I mean, when management authorizes massive open market purchases like that, they are essentially telling the public that they believe the stock is undervalued relative to the cash the business is generating.
Right.
And they still have 7.8 million shares left in their total buyback authorization. So they have plenty of dry powder to keep supporting the stock.
We should probably also touch on their book value. Tangible book value per share now sits at $25.52, which is actually up 15% from the prior year.
That's solid growth.
Yeah, and for our newer listeners, tangible book value is essentially a worst-case scenario metric. It means if Stifel ceased operations tomorrow, liquidated every desk, server, and performing loan, and paid off all their debts, shareholders would theoretically receive $25.52 per share in hard cash, totally ignoring any abstract value like brand name or goodwill.
Right. And seeing tangible book value compound by 15% in a single year is a hallmark of really strong balance sheet management.
I see the strong margins and the buybacks, but I have to play devil's advocate for a second.
Stay free.
Because we're combing through these expense lines, and I found a pretty glaring red flag in the Global Wealth Management unit that we really cannot ignore. The provision for credit losses jumped by 50%.
Yeah. It went from $8.3 million in Q2 of last year to $12.5 million this quarter.
Setting aside $12.5 million for bad loans is a massive spike. And I am not going to just write this off as normal accounting noise. We are still sitting in a historically high interest rate environment. Credit cards are maxed out. Commercial real estate is struggling all over the place. Is the consumer finally cracking? Like, are defaults quietly spiking under the surface of these record revenues?
Your skepticism is entirely justified. And frankly, it's exactly the kind of pushback you should have when looking at bank earnings right now. But we have to separate the actual underlying credit quality from the mechanics of current banking regulations here.
Yep.
Because this 50% increase in the credit loss provision is mathematically driven by loan growth, not by a sudden wave of loan defaults.
I need you to walk me through the logic on that. Because how does successfully growing your lending business result in a financial penalty on your quarterly income statement?
It comes down to a recent accounting standard called CECL, which stands for Current Expected Credit Losses. So during this quarter, Stifel expanded its bank loan portfolio by $2.6 billion, bringing their total loan book to $24.8 billion.
Right.
Under the old accounting rules, a bank only took a loss provision when a borrower actually missed a payment. But under CECL, the moment you originate a brand new, perfectly healthy loan, you are legally required to run macroeconomic models and predict the total expected losses over the entire lifetime of that loan.
Wait, you have to book that expense on day one?
Literally on day one.
Oh, wow. So because they added $2.6 billion in new loans to the balance sheet, they were forced by regulators to immediately set aside millions of dollars for hypothetical future losses, even if every single one of those borrowers has a perfect credit score and is paying on time today.
Exactly. It's basically a mandated upfront tax on balance sheet expansion. The $12.5 million provision isn't reflecting current defaults. It's just the required buffer for originating massive amounts of new performing loans that are going to ultimately generate net interest income for years to come.
Okay, I hear the accounting logic, but I am still a bit cautious. The models predicting those hypothetical future losses can be wrong. We've seen banks under provision before.
Oh, for sure.
So it is absolutely a metric you have to watch in future quarters to ensure those mathematical provisions don't slowly morph into actual realized charge-offs.
You are absolutely right to monitor it. The provision line tells you what the accountants predict. The net charge-off line tells you what is actually defaulting. As long as charge-offs remain low, this provision is purely a growth mechanism.
Yeah.
But yeah, it requires constant vigilance.
So pulling all of these threads together, the final synthesized takeaway for you as an investor is pretty clear. Stifel's Q2 wasn't just a revenue beat. It was really a masterclass in how a diversified financial firm is supposed to operate. You have the anchor of the wealth management division continuously pulling in sticky, fee-based assets because they've built a culture that top-tier advisors actually want to join.
Yeah, and then you have the opportunistic upside of the institutional group, perfectly positioned to capture the massive influx of investment banking fees the second the capital markets unfroze.
Right. And crucially, you have extreme management discipline. I mean, they're lowering their compensation ratios, they're brutally cutting low-margin operations like European equities, and they're aggressively using their cash to buy back stock. It is just an incredibly clean quarter.
It really sets a high benchmark for the rest of the financial sector reporting this earnings season.
But before we wrap up, I want to leave you with a macro question to think about. Something that goes far beyond Stifel's performance over just the last 90 days. It goes back to our discussion on artificial intelligence.
Ah, the Iron Man suit strategy.
Exactly. Historically, Wall Street wealth management has always been an extremely human capital-intensive business. That is why compensation ratios sit in the high 50% range. You need a massive army of junior analysts, associates, and administrative staff to support the lead advisors.
Right, and the more clients you take on, the more support staff you have to hire.
Yeah.
Which basically keeps your profit margins fundamentally capped.
Exactly. But if Stifel is successfully using AI to automate the heavy lifting, slashing prep time, automating compliance, structuring those slide decks while keeping the human advisor at the center of the relationship, what happens to that margin cap?
That's the billion-dollar question.
If AI makes an advisor 40 or 50% more efficient, they can manage vastly more client money without the firm needing to hire that proportional army of support staff.
It completely changes the unit economics of the entire industry. I mean, if you don't have to scale headcount linearly with your asset growth, your compensation ratio just plummets.
So the question you need to mull over is this. Will financial firms that successfully blend this AI efficiency with high-touch human advising eventually start operating with software-like margins? Silicon Valley SaaS companies routinely run with massive profit margins because software scales infinitely. Wall Street never could.
Right.
But if AI bridges that gap, will the broader market have to fundamentally rethink how it prices these financial stocks? Like, could we see wealth managers re-rated to trade at tech sector valuation multiples over the next decade?
I mean, if a traditional bank proves it can achieve tech sector operating leverage while maintaining its sticky client relationships, the historical valuation models go straight out the window. It is arguably the defining question for the next era of financial services.
And it is exactly the kind of structural shift we will be tracking closely. Make sure you hit follow on the show so you do not miss our daily no-nonsense coverage of the earnings reports that actually matter. See you next time.